Analysts expect total spending on artificial intelligence infrastructure to reach between $3 and $4 trillion by the end of this decade. That is a massive wall of capital moving into a single sector. Tech giants like Microsoft, Google, and NVIDIA are already making trillion-dollar bets to capture their share of that incoming cash. They are building the physical pipelines that will process tomorrow's digital economy. But at the same time, anxiety is building. We are seeing historically high market valuations, and serious financial analysts are openly questioning if we are currently sitting in an AI bubble. That leaves you with a specific choice. You have to balance the prospect of compounding capital as this technology matures against the very real danger of watching your savings evaporate in a sudden market correction. Simply buying AI is no longer a specific enough strategy. Because these companies operate using completely different financial mechanics, they carry entirely different levels of exposure. Sustainable investing here requires aligning a company's specific role in the ecosystem with your own requirements for stability. Institutional investors don't view artificial intelligence as one massive monolith. They look at it as a stacked ecosystem. This diagram shows the 4 layers of the AI tech stack: hardware, infrastructure, cloud, and software. Your financial volatility changes drastically depending on your investment. The foundational hardware layer sees rapid price swings, while upper layers offer insulated stability. Today, we are going to evaluate the 7 most discussed AI stocks through this exact framework. By breaking them down layer by layer, we can see exactly where they fit into your portfolio. Understanding where a company sits inside the stack provides a practical framework for assessing risk if AI valuations begin to contract. Let's start at the absolute bottom of the stack, the foundation layer, and that means starting with NVIDIA. NVIDIA controls an estimated 80 to 90% of the entire AI training chip market. Their H100 GPUs and next-generation Blackwell architecture are the literal engines powering the current build-out. But their true competitive moat is actually their software. Their CUDA ecosystem forces AI engineers to optimize their codes specifically for NVIDIA hardware, making it incredibly expensive and difficult for companies to switch to a competitor. Here is their extreme vulnerability. If the massive tech companies suddenly decide to slow down their capital expenditure and buy fewer chips, NVIDIA is the first stock in the stack that will feel the impact. Broadcom offers a different profile within the hardware layer. While they build custom AI accelerators, they also dominate the market for networking switches. Crucially, their software division provides a predictable, recurring revenue stream that helps offset the boom and bust cycles typical of the semiconductor industry. The foundation layer gives you the purest, most direct exposure to the infrastructure boom, but it demands an investor who can handle sharp, sudden price corrections. Moving one level up the stack, we hit the cloud layer. This is the territory of the hyperscalers. Microsoft is playing a strategy of total integration. By embedding their Copilot AI across Azure, Office 365, and LinkedIn, they are forcing widespread enterprise adoption across businesses that already rely on their software. Alphabet took a hit last year when people thought AI would destroy Google search. Instead, they integrated their Gemini models directly into search and YouTube, protecting their 36% operating margins and maintaining their existing dominance. Then there's Amazon. AWS serves as the central backbone where other companies train their models. And behind the scenes, Amazon is quietly developing its own custom silicon, Trainium and Inferentia, specifically to reduce their reliance on NVIDIA. All 3 of these giants share one massive strategic advantage. They generate immense free cash flow from their legacy businesses, whether that's e-commerce, traditional cloud hosting, or global advertising. Buying into the cloud layer dilutes your pure AI gains, but it provides a crucial financial safety net. If AI spending slows down, their legacy businesses keep the floor from falling out beneath you. Now we reach the top of the stack, the application and analytics layer. This is where AI actually interacts with the end user. Meta is making a high-stakes gamble. They are pledging up to $145 billion in capital expenditure by 2026, pushing AI directly into consumer hardware and embedding it across platforms used by over 1 billion people monthly. This strategy relies on their massive existing user base. We are already seeing the impact on their legacy advertising business, where revenue surged 33% specifically because of their new AI-driven targeting systems. Contrast that consumer approach with Palantir. They operate an entirely different business model focused on big data analytics, built strictly for large enterprise clients and massive government defense contracts. Government contracts offer long-term stability, but Palantir carries its own specific risk. It is one of the most expensive stocks in the market relative to its earnings, making it highly sensitive to any shift in market sentiment. The application layer is the most detached from the initial hardware build-out. Because they sit at the very top of the stack, these companies face the longest timeline to prove true return on investment for the hardware they are buying today. We've looked at the companies. Now we map them directly to your personal financial requirements. This chart is the AI risk and reward matrix. It weighs pure AI growth potential on the x-axis against legacy downside safety on the y-axis. For an aggressive optimizer, willing to accept lower safety for maximum exposure, you want NVIDIA and Palantir. If you are a defensive compounder, prioritizing stable legacy revenue, you belong with Microsoft, Amazon, and Alphabet. Broadcom and Meta sit in the middle. They offer more AI upside than cloud giants, but their legacy revenues provide a buffer. Successful investing depends on whether your stock pick matches your ability to tolerate a market correction. For a more resilient portfolio, consider the layered approach. Blend heavy allocations in cloud giants to establish a stable baseline and add a fractional allocation in hardware, creating a portfolio capable of navigating different market cycles. Pay attention to your entry prices. A high-performing AI company becomes a poor investment if bought at the absolute peak of a market cycle. As always, this is for educational purposes. I am not a financial advisor. Always do your own research and consult a professional before deploying your capital into these markets. The multi-trillion-dollar shift in infrastructure is already underway. Before you buy a single share, figure out exactly which of those 3 investor profiles fits you best. Thanks for watching.